Okay, welcome to part 2 of the lecture for chapter 4. I'm going to pick up where I left off in the last lecture with bank statements. So reconciling the bank statement, reconciling means comparing and researching all of the differences between our internal records and some outside objective source of information. That's the reconciliation process. So in this case, we're reconciling our checking account, or what we think we have in the bank, with what the bank says we have in the bank according to the bank statement. Here's an example of a bank statement, and all of them are a little bit different. Usually they're in PDF form, but it's going to call out the account number. That's in the upper right corner there, the period of time that's applicable, and then it'll give a quick little summary of the activity in the account. So the beginning balance plus deposits minus withdrawals gives us a new or ending balance of $33.59.78. So that's what the bank says we have in our account. Then it'll show all of the details of checks that have cleared the account. So when we write a check and we send it to somebody, it takes several days for it to get to them and for their bank to deposit it and present it for collection against your bank. So this is what has cleared the bank, and then deposits and other kinds of charges. So the problem is the bank says we have one amount, but our records are nearly always going to show that we have a different amount in the bank because we've written some checks maybe that haven't cleared the bank yet, so there's some money there. There could be other differences. So the question is, which number is correct and which number should we report on financial statements? Well, in order to do that, we need to do a bank reconciliation. So we need to investigate the difference between those two figures. And that's done in two parts, and I'll explain the two parts and then show you the whole thing. So the top part is the bank section. That's where we start with the ending balance as per the bank, and then we add and subtract anything to that we know about that the bank doesn't. Usually that's two different categories. There might be deposits that we made after the bank closed at the end of the month that they don't know about, but we show as being deposited. And then there could be the comment I made earlier about outstanding checks. There could be checks we've written, especially near month end, that we've mailed to somebody, and the bank doesn't know about those checks because they haven't been presented for collection yet. So if we take the ending balance according to the bank, we add deposits not recorded, subtract outstanding checks, that'll give us an adjusted bank balance. Then we go to the second section, the company section, and here's where we start with the ending balance according to our records. So what does it say in our check register for how much we think we have in the bank at the end of the month? And then I'll do the same process. I'll add to that and subtract from that anything that the bank knows about that we don't know about. So a couple of categories of those. One could be a deposit that somebody made directly to our bank account for an amount they owed us, and we didn't know about it until we saw our bank statement. So that could be money that went into our account that we didn't know about. We would add that to our ending balance. And then there might be, which is far more likely, charges that the bank has made against your checking account. And that could be charges for just service charges for having an account there. It could be reprinting checks. It could be when a customer bounces a check to you and it's labeled non-sufficient funds or NSF, the bank will pull that money back out of your account. So those could be examples of charges that have hit your account that aren't reflected in your accounting records. So the company adjusted balance will be the ending cash balance as per the company, plus any additions the bank has made that we didn't record, minus any deductions, and that'll give us an adjusted company balance. Now, the last step is to make sure those two amounts equal each other. So here's an example where the top portion shows the cash balance according to the bank of $33.59.78. There was a deposit not recorded by the bank, must have been made after hours. We add that, subtract those three outstanding checks, and they come to an adjusted balance of $26.30.99. Now we look at the company's checkbook. They have an ending balance of $25.49.99. There was a note and interest that was collected by the bank, so we'll add that. And then there was an NSF check, a bank charge, and then an error that was made that we found in the process that was deducted from, that we should deduct from that balance. And so we end up with the same $26.30.99. So we're reconciled at that point. Then we need to record those items that aren't reflected in our accounting records. We need to make entries so that we get that into our accounting records. So this process of reconciliation is important in the sense that it can be a way that we can find mistakes that have been made. Again, I did this before and I found checks that had been written on my account that weren't written by me. So it's a way of kind of detecting if somebody has added a zero to a check that you wrote. This is how you would find that sort of thing. So it's an important element of internal control to do this process, this bank reconciliation process, for every bank account for every month. Next thing I want to talk about is the code of professional conduct that all accountants adhere to, especially CPAs. So when I received my CPA license, I agreed to abide by this code of professional conduct. And if I don't abide by it, I could lose my license. So just some of the high points of this. They expect accountants to exercise professional judgments. Meaning they keep information confidential, they behave as a professional, they handle people in their own interest, in the interest of your clients. Next is the public interest, and that really underscores the fact that the client of an accountant, especially an auditor, is the public in general for getting accurate financial information, not just the client that's hired you. Next is integrity. That's you should be honest and your action should be consistent with that honesty. Next is objectivity and independence. So you shouldn't take commissions for the work you do, especially that's contingent on the result. You should be free of any conflict of interest. So you should be completely independent from the clients that you're reporting on. Next, due care. So you should make sure that you maintain your education so that you can do a proper job for that which you're hired. And then last, scope and nature of services. That's you observe the principles of the professional code of conduct everywhere you do these functions. So the last thing I want to talk about is the annual report and the role of an auditor. So companies, whether they're public or private, will produce an annual report at the end of their fiscal year. Okay, and fiscal years could differ from calendar years. So that annual report is going to include financial statements, the four we've talked about: an income statement, statement of stockholders' equity, a balance sheet, and a statement of cash flows. In addition to that, it'll include notes to the financial statement. So if you need to describe a particular accounting policy or how you arrived at your revenue figure, or if there's some explanation needed for the figures in the financial statements, that's where you would include that. And then there's a section that's more done in publicly traded companies, management's discussion and analysis. So here's where management talks about the challenges and the opportunities in the past year and what their strategies are going forward. It's a bit of a marketing kind of a thing almost. And then lastly, there's the opinion of the independent auditor. So we haven't really talked yet about why auditors are necessary. So auditors are certified public accountants that will come in and look at your financial statements, verify that they're done correctly, and then attest to the fact that they are correct and in compliance with generally accepted accounting principles. So the reason that is necessary is if you think about, say I have a company and I want to borrow money from a bank. I could take my financial statements to the bank and say, look how good I'm doing, please loan me money. Now the bank knows that I have an interest in making those financial statements maybe even look better than they really are. And so they wouldn't trust just my financial statements that I've given them. They'd want an independent, objective third party that understands financial statements to come and look at them and vouch for them effectively. Say, yes, these are correct. I've done an investigation. They're accurate. You can trust these figures. And then the bank would be willing to make the loan based on that. So that's the role an independent auditor will take. And so when they're engaged, they'll go through and they might contact some customers to verify amounts that the company says those customers owe to them. They'll verify the revenue figures and expense figures and make sure that no liabilities have been omitted, those sorts of things. And once they get to the point where they have finished all of their work, they'll issue an opinion that'll be one of three types of opinions. Either one, it will be unqualified, which sounds like a bad thing, but it means that they're not making any qualifications. They're saying everything is good. So that's what you want. Next, there could be a qualified statement. So they might say everything is good except for X because we have this issue with it. And then in the worst case, they would issue an adverse opinion, which is to say these financial statements do not reflect the reality of this company's performance and their financial condition. They're not in conformance with generally accepted accounting principles. So that's pretty much a bad deal. So those are the three types of opinions you can get from an auditor, and that's the role that auditors play. So that concludes the second part of the audit for this chapter. So I will talk to you again when we speak about chapter 5. Thanks.